In this video, Dan Niles analyzes the potential repercussions of a 41% year-over-year increase in U.S. imports on major tech companies, particularly the Magnificent Seven. Dan highlights Microsoft's Azure cloud business as a standout performer amidst mixed results from Google Cloud and AWS, and expresses caution regarding NVIDIA's long-term prospects despite positive trends.
Is the fact that there was a ton of pull forward in demand because of tariffs and fears of export control. So if you look at GDP in Q1, imports were up 41% year over year for the United States. To find something even close to that big, you have to go all the way back to COVID. And imports were up over 88% in the third quarter, but that's because they were down 54% in the second quarter during COVID in 2020, and they were down, I think it was like 12% in the first quarter. So that's a massive pull forward for companies like Apple or like Amazon, where it's funny, you listen to the conference calls, and very few of these companies were saying that there was much of a pull forward, if any, including Apple. And I think you look at that GDP number and you go, if it's up 41%, how can these companies not be seeing it? We're some of the biggest in the world. So I think there's going to be a big payback coming in the back half of the year, because let's say you bought an iPhone to get in front of tariffs, or a Tesla or stuff off of Amazon. You're not going to need to buy a new car or iPhone in the holiday quarters. And so that's where I think we're going to have a big problem.
Let me raise one more issue that was talked about here this weekend, and that's just the idea that what these big tech companies are, their model has really changed over the last few years. You know, Berkshire has $350 billion almost in cash on hand. That's way more than these big tech companies have at this point. In fact, that's more than Apple, Microsoft, Alphabet, and Amazon combined. We've always thought about the Mag 7, these big tech companies, as being capital light, basically printing money and not having to have a lot of capex. But over the last many years, they've been spending a lot of money on trying to chase the AI boom. Does that change the proposition of what these companies are as investments? Apple would be the exception in that. You know, it's not spending billions of dollars, or tens or 20s or 30s or 40, billion dollars or more chasing this stuff. But does that change the valuation or the investing proposition?
Well, the thing you have to remember, Becky, is that you get into these periods of times where people go, well, I can't lose. And the one that's kind of akin to this is the internet. And you spent a good 6 years kind of building that out from the time you got the first web browser out. And, my analogy is, I remember John Chambers at CEO of Cisco back in 2000 saying, we think we can grow this company 40 to 60% sustainably. And in fiscal 2000, he grew it at 55%. Since then, for the last 24 years, the company has compounded revenues at 4.5%. That's a lot lower than 40 to 60%. I think we can agree.
Yeah.
And there were negative quarters in there, 6 negative years in there of growth. So, when you look at the AI landscape today, the thing you have to remember is, much like in the internet, when you had cost drop massively, and the companies that really benefited were the ones sitting on top of that. So think Netflix and streaming, Amazon and e-commerce, Google and search, Meta and social. Those were the ones where the value accreted to them. You look at today, and you're already starting to see a cutback in AI spending. I love the media coverage that it's really strong and companies double down. But if you look at it, of the 4 that reported, Meta, Microsoft, Google, and Amazon, their AI capex was down sequentially for the first time since 2023. And if you look at Microsoft, their AI capex, and they obviously were an investor in OpenAI back in 2019 when none of us had even heard about OpenAI, their capex was down for the first time since 2022. So you're already starting to see some of these companies starting to cut back on their AI spending. And I think to some extent, that could be good for them, because when you're running over 30% of your revenues is capex, you're going to see a massive spike in depreciation. And unless you're getting some payback, that's going to become an issue. So there's going to be a lot of changes, I think, going on for the rest of this year. Don't forget, tariffs were rolled back on semiconductor chips also. And so I think there was a big pull forward in demand there by the hyperscalers as well. And some of that's going to get unwound in the back half of the year. You can't have imports up 41% for the entire United States of America and not expect some kind of payback on the back end of this.
So if you think that we've seen the best of the rally, that things get a little rougher from here, which, if any of these stocks are your favorites?
Well, I mean, you have to look at the big trends. I think with Microsoft, remember for the last, this is the first time in the last 4 quarters that Azure, which is their cloud business, has actually done well. It's disappointed the other prior 3 quarters, and their Azure growth actually accelerated from 31% to 33% growth year over year. You look at Google Cloud or you look at Amazon Web Services, their growth actually decelerated by 2% each. And Microsoft this year is actually getting their spending under control. And I think there's a reason why this is the best performer out of the Mag 7 so far this year. Last year, they were the biggest spender and ramped it up the fastest. There's a reason they were the worst performer of the Mag 7 last year. So I think that one's interesting. The other one, and this is a tricky one, is NVIDIA. Because, you know, when I watch the media coverage, everybody's saying, oh my God, AI spending, everybody's spending a ton. And I think investors want to believe that. Don't forget, this stock was down 49% from peak to trough with the stock price. Nothing will spur demand like saying, you can't have that chip, we're going to put an export control on you. And oh, by the way, tariffs are coming. That has pulled in a ton of demand. They've also de-risked the income statement, because they're writing off $5.5 billion worth. This is going to make it so gross margins can go up going forward. So, you know, I think investors want to believe it's good versus it's a pull-in. That stock probably does okay in the near term, but I think the back half it's going to have another set of issues.